Understanding charts, line, bar, and candlestick basics, brought to you by the Falai Trading Academy, where we trade smart and invest better. My name is Ade Falai, and this is the fifth in the Beginner's Guide to Trading series, which acts as a refresher course for already experienced traders or the beginning for new traders in understanding what exactly is involved in trading the various markets we trade. What are trading charts? Trading charts are visual representations of price movements over time, and they help traders analyze market trends and make informed decisions. There are three different types of charts. The first are line charts, and the line chart shows price movements with a simple line connecting closing prices over time. It's great for beginners, but it lacks details, and lots of professional traders don't use line charts. This is a visual representation of line charts. As already described, it shows you the close price of each asset you're trading without giving you much more detail. Next, we have bar charts. Bar charts display open, high, low, and close prices for a specific period. They're more detailed, but they can be harder to read. And this is how bar charts are displayed. The red ones are bearish and the green ones are bullish. Candlestick charts. Candlestick charts are the most popular charts among traders, and it shows the same information as bar charts, but in a more visual and easy to understand format. These are candlesticks, and the green are bullish, red are bearish, and we use candlestick charts at the Falai Trading Academy. We now look at the anatomy of a candlestick. Candlesticks represent price movements within a specific time frame, whether it's 1 minute, an hour, or 1 day. Key components of a candlestick. The body. The body represents the open and close prices. A green or white candle means the price closed higher than it opened, while a red or black candle means it closed lower. This is a green candlestick, which is a bullish candlestick, and the open price is lower than the close price, as already described. And this is a bearish candlestick, where the open price is higher than the close. The wicks or shadows. Wicks or shadows are the thin lines above and below the body that show the highest and lowest prices during the time frame. So we have an open and close price, and the wick above shows the highest point price went to before being rejected, and also the lowest point price reached before being pushed back up. And this is a bearish candlestick. Wick on the top, wick on the bottom. The open price is higher than the close. How to read candlestick patterns. Candlestick patterns are combinations of candlesticks that signal potential market moves. So in order to have a pattern, you need a previous candlestick and a current candlestick. Basic candlestick patterns, we have bullish engulfing, and this occurs when a large green candle completely engulfs the previous red or green candle, signaling a potential reversal in the prevailing trend. And we have here a number of bearish candlesticks. So when we have 3, 4, 5 bearish candlesticks, this is known as a trend, and it's followed by a bullish engulfing candlestick, meaning the close price is higher than the open price of the previous candlestick. Now, the textbook definition actually says when a bullish candlestick engulfs a previous bearish candlestick, but I'll use this next example to show you that that's not necessarily the case. A bullish engulfing candlestick occurs when the open and close, or the close price, I should say, is higher than the open price of the previous bullish candlestick as well. So in this example, you can see that there was a bullish candlestick which is opposite to the prevailing trend, but it didn't engulf the previous bearish candlestick. but the most recent bullish candlestick engulfed the previous one, and by definition, this is a bullish engulfing candlestick. Bearish engulfing. This occurs when a red or a large red candle completely engulfs the previous green or red candle, signaling a potential reversal in the prevailing trend. So it's the opposite of a bullish engulfing candlestick. We have a series of bullish candlesticks. We have a bearish candlestick which doesn't engulf the previous bullish, so we ignore this. And we then have a big red engulfing candlestick which completely engulfs the previous bullish candlestick. So this is one of the examples of a bearish engulfing candlestick. Another example is when we have two bearish candlesticks in a row. As in the previous example, a bearish candlestick was formed, but it didn't engulf the previous bullish candlestick, followed by another bearish engulfing candlestick. So this candlestick engulfed the previous candlestick, and by definition, this is a bearish engulfing candlestick. Doji. A doji is a candle with almost no body, showing indecision in the market. So it could mean a trend reversal is coming, but not necessarily the case. This is a doji candlestick. As you can see, massive wick on top, massive wick below, and the body of the candlestick is relatively insignificant. It's almost less than the size of a pip. So a doji usually means something might be changing in the market, but it's no guarantee. It's just an early warning sign. Next, we have hammer and shooting star. A hammer shows potential bullish reversal, while shooting star shows potential bearish reversal, depending on their position in the trend, of course. So, example of a hammer, or visual display of a hammer, I should say. We can see here that there's a massive wick below the candlestick, and the opening price is below the close price. So it's a bullish candlestick with a massive wick underneath. Next, we look at the shooting star, and the shooting star is the opposite of a hammer. We see here that a massive wick above the bullish candlestick, with price closing above the open. So it's bullish, but the size of the candlestick itself is insignificant in comparison to the wicks on either side. And a bearish or a shooting star could be an early sign that price could be going bearish. It's an early warning sign. It's not a guarantee. It's just something for you to pay attention to when it occurs while you're trading. Time frames and their importance. Candlestick charts work across different time frames, from 1 minute to monthly charts. So the time frame you choose depends on your trading style. Short time frames, these are 1 minute, 5 minute, and 15-minute time frames, and they're ideal for day traders looking for quick trades. Medium time frames, we have the 1 hour, 4 hour, or daily, and they're great for swing traders holding positions for a few days. Long time frames, which are weekly or monthly, and these are best for position traders and investors with a long-term focus. Practical tips for using charts. Start simple. Focus on basic patterns and 1 or 2 time frames when starting out. Don't overcomplicate. Avoid adding too many indicators. Candlesticks alone can tell you a lot about market behavior. And at the Falai Trading Academy, we use indicators, including candlestick patterns, to make our trading decisions. Practice on a demo account. Spending time reading charts and identifying patterns without risking real money is one of the best ways to start seeing your trading journey. Now, I always recommend trading demo just to understand candlestick patterns and how candlesticks are formed, or the early signs you can read from candlesticks, because trading takes knowledge and experience, and having knowledge without the experience of trading will not make you a consistently profitable trader. So my approach would be practice on a demo account, and when you're more comfortable or you've gained a bit more confidence, you can then go to trading real funds on a small account, of course. So final thoughts. Candlestick charts are one of the most powerful tools in a trader's arsenal. By understanding how to read them, you start seeing patterns and opportunities that other traders miss out. This is definitely true, and my experience in trading confirms this, because without understanding candlestick patterns, you can end up holding on to losing trades or closing winning trades too early. In the next video, we'll take things a step further and explore technical indicators. And these are tools that can complement what you've seen on the charts. I'm a user of technical indicators. I use both on-screen and off-screen indicators to make my trading decisions. So if this video has been helpful in any way, give it a thumbs up. Don't forget to subscribe. And if you have any questions about the topic I've covered today, put in the comment section below, and I will endeavor to answer your questions and even maybe make a video to help you understand the point better. So thanks for joining us today, and I'll see you in the next video.